Hey, Dr. Crone again. Welcome to our very last video lecture in this course. It's on state taxes. Congratulations for making it this far. It's been quite a journey. Let's talk about state taxes. So states take in three general types of revenue. Remember, revenue is just money coming into the state that then they can spend. So states can use taxes. They can use fees. Fees are things like, say you want to go camping in Ohio and you go to a state park, you pay a fee, and some of that money goes towards keeping the park going, but some of it goes towards the government. So taxes, fees, and then what's called revenue sharing. Revenue sharing is money that comes from the federal government in the form of grants. The majority of this goes to Medicaid, but it could be other forms of grants, particularly for fiscal federalism type programs. And so here you can see the map with the most recent data. This is from the Tax Foundation. They're an interest group that follows federal spending. What this basically shows is the percentage of money in a state's budget that comes from the federal government. So you can see in Ohio, we're kind of in the middle of the pack. About a third of our revenue comes from the federal government, which means 2/3 of it comes from state sources. Montana is the number one in terms of the chunk of the pie that they rely on the federal government for. One thing that's kind of interesting is that the states with the highest share of revenue from the federal government tend to be Republican states, which is kind of ironic since Republicans usually are very much valuing a small federal government and state self-sufficiency. So it's kind of interesting to see that those governments take in more of the money they take in, I should say, is from the federal government rather than from taxes on their own citizens. So other than revenue from the federal government, the main source of state revenue is taxes. And taxes are a very difficult and politically hot topic, politically very dangerous topic. We call it a hot potato if you've ever played that game where you pretend a ball or something is a hot potato and you have to throw it as fast as possible. That's kind of the way taxes are for state governments. They're necessary, but boy, do they hate to have to deal with them. And part of the reason is that at the heart of it, voters hate paying taxes. Nobody likes paying taxes. And so if voters hate something, the natural political inclination is to also hate them and say, yes, we won't do things that voters hate. That's kind of at the heart of winning elections. But the problem for state government is that states have to have some form of revenue. It's critical for running the state. Especially states have to do this because they don't have the luxury of running a deficit the way the federal government does. In the last many years, especially under Republican governance, the federal government has cut taxes and raised spending at the same time, which they can do because they can borrow money. But states don't have the luxury of doing that. They have to balance their budget, or most states do. And so they have to make hard decisions about taxes, which they know are going to often be not so positive with voters. So states have lots of different kinds of taxes that they rely on, and all states rely on some kind of complicated mix of lots of different types of taxes. So we've already talked about property tax. That's usually a local tax for local spending, especially for schools. But there's also states rely on income tax. That's the tax we pay that comes right out of our paycheck. Sales tax, that's the tax that gets charged when you buy something. User fees, these are things where we pay money to use something. I mentioned the state park campgrounds. Tolls for a turnpike. Actually, tuition is a user fee. Hotel taxes, charging fees to people who stay in hotels or who buy an airline ticket or a concert ticket. Those are all user fees. A very popular form of tax is called a sin tax. That's tax on things like cigarettes or alcohol that is considered to be sort of morally questionable. Governments love sin taxes because voters tend to really like sin taxes. They're the most popular kind of tax from a voter's perspective because the idea here is that you have total control over whether you pay the tax or not. If you don't like a tax on alcohol, don't drink. If you don't like a tax on cigarettes, don't smoke. So states tend to really like sin taxes. There are severance taxes. Those are taxes that are transferred to other states and to companies that take things out of Ohio that are hard to replace. So for example, let's say a coal mining company comes in from another state and decides to mine our coal. They would be charged a very high severance tax on that, and to basically make up to the state of Ohio the fact that they're taking a resource that can't be replaced. Gambling revenue, that's a huge thing that states use for income. That we've talked about casino gambling, running the lottery. Anytime gambling is expanded in the state is doing that to try to increase revenue. One of the biggest arguments in favor of legalizing marijuana is that the state could regulate it and charge taxes on it, and that would be the ultimate sin tax. States even take in money by selling you things like a vanity license plate, the fee that you pay for that, or the fee that you pay for just to get your driver's license. All those things are ways that states try to pay their expenses. So some of the categories of taxes we talked about are fairly easy to get away with when you're a state legislature. So things like gambling revenue or sin taxes, those are all things that aren't very tremendously controversial. But a lot of the categories of taxes are politically challenging, and two of those are income taxes and sales taxes. And part of the reason they're challenging is because whenever you're trying to tax somebody, issues of fairness come up. How does the state decide who gets taxed and how much different people get taxed? What principle of taxation is fair for citizens? And there are different perspectives on that, and they come down to three different sort of revenue principles, I guess we could call them, that are different answers to the question about what's fair for taxation. So let's talk about those principles. So one kind of well-known type of revenue generation or revenue principle is called progressive taxation. And progressive taxation, as you might guess, was favored by our friends, the progressives. This is the form of income tax we have at the national level, and many states have this as well. This is a sliding scale income tax, where the more income you make, not only the more tax you pay, but the higher the percentage of your income you pay. And I'll have an example of that in a minute. So richer people are charged a higher percent on their incomes than middle or poorer, lower income people. Regressive taxation is a tax where it's a tax on the value of an item that's purchased. So in general, it's a sales tax. And that sounds like it'd be fair. We're going to charge you 5% on buying your groceries. But the trouble with this, and the reason it's regressive, is that actually when you look at the percentage of money that people have to spend and how much of it goes into taxes, it's a higher burden on people with lower income. So it's actually the opposite of a progressive or sliding scale tax. It's a tax that in a hidden way actually falls higher on poor people. And we'll look at that, an example of that in a minute, because I know that's hard to understand. Finally, there's what's called a proportional or a flat tax. And this is a tax that charges an equal percent on all incomes, regardless of how high or low they are. And that is, some people say, well, that's the most fair way to do it. So let's look at these, some examples that will help you to understand the consequences of these, and then we can talk more about those, and you can make up your own mind. So if we look at the difference between a progressive tax and a proportional tax, on the left you have a progressive tax, and I'm just showing an example. This would be a common sort of distribution for a progressive income tax in a state. So if you're someone who's making the bottom end of a middle level income, you're making $30,000 a year, let's say in our hypothetical state, you'd pay 4% of your income, which would be $1,200. If you were making 100,000, so a solid middle class to upper middle class income, you'd pay 7%. So here we see that you'd pay more than, not only would you pay more money than the person who was making 30,000, but you'd actually pay a larger chunk of your pie of income. Meanwhile, if you were in a super wealthy category with $1 million of income, you might pay an even higher rate, let's say 10%. That's what we mean by a progressive scale. And this, of course, the principle of this is that the largest burden of taxation falls on the people who are the most wealthy. Some people, generally speaking, liberals and Democrats usually are in favor of this kind of taxation. But some people think that it's not fair. It's not fair. It's a disincentive to earn money and work hard if you're going to just have to get in a higher tax rate and or what's called a tax bracket and pay more money. So oftentimes the people who argue that this isn't fair will advocate for a proportional or what's called a flat tax. And a flat tax means that no matter how much money you make, you pay the same percentage of your income. So what we see in a comparison here is that our richest person is still going to pay quite a bit more than our middle income or lower income person is going to pay. But it's not going to be a higher percentage of their income. And one effect you can see here is that for our kind of very bottom of the middle class $30,000 earner, they're actually paying quite a bit more in taxes than they would if we had a progressive sliding scale tax. Regressive taxes are probably the hardest to understand. Regressive taxes are sales taxes, and they sound like a flat tax because they're a flat percentage on the cost of any individual item. So for example, a gas tax is, in Ohio, our gas tax is 38 cents a gallon. So that is charged to everybody, no matter who you are, no matter how much money you make. If you fill up your car with gas, you're going to pay 38 cents a gallon in taxes on that. Sales taxes are usually a percent of however much you spend. So in Ohio, actually in Franklin County, our sales tax is 6.75%. That's state plus an add-on for local taxes as well. And that sounds fair, right? Hey, anything you buy, you're going to pay the same amount of tax on it, no matter who you are, no matter how much money you make. But the problem and the reason why this is considered regressive, especially by Democrats and people of a more liberal ideology, they don't like this because what it ends up happening is you end up, because people with low income spend a higher percentage of their money than people with high incomes, you end up paying more taxes on money that you spend. You end up paying a higher percentage of your income on taxes. So I know that's kind of counterintuitive, but if you think about it, somebody who's making a large income, let's say $400,000 a year, doesn't have to spend every cent that they have on their basic living expenses. They have a lot of money left over for luxuries or to put into savings and investment or both. Whereas somebody who's making a low income, like $20,000 a year, they're barely meeting their basic income, their basic expenses for rent and food and things like that. And so they don't have a lot of money left over. So let's look at a gas tax. So here we see an example. Let's just assume that everybody in this example drives the same amount of time. You don't have to drive less just because you're poor or drive more because you're rich. Let's say you're commuting to work the same distance and you need 20 gallons a week to do your commute. And that means each one of our households will pay $416 a year. Basically, this is yearly, in gas tax. What we see is that for an annual income of $400,000, that's a tiny slice. That's only 0.1% of that person's income. Whereas for somebody with an annual income of 20,000, it's 2% of their income to pay the tax on gas, not just to pay for gas, but to pay the tax on gas. Same with diapers. You know, rich kids don't poop any more than poor kids do. But if you are spending $60 a week for 2 kids in diapers, that's about what it costs to diaper 2 kids. If you're spending that much, $60 weekly, that means you spend every year $208 that you pay to the government to pay for that tax on diapers, which is only a minuscule 0.05% of a $400,000 income, but it's 1% of your $20,000 income. And again, that doesn't mean you spend 1% on diapers. It means you spend 1% paying the government tax. So if you look at this, the outcome of it is the opposite of a progressive tax, where you're actually taxing the poor more money off their income than you are, or a higher percentage of their income than you are for someone who's wealthy. If you just presented that as a tax and said, hey, I know how we should tax people, let's tax a higher percentage of income to poor people than rich people, most of us would say, well, gosh, that's not fair. But if you say, well, it's a sales tax and it's just a flat tax per gallon of gas, or a flat tax on the cost of paying for diapers or something like that, it sounds more fair. But it is quite problematic, and many people don't like regressive taxes for that reason. So because taxes are so tricky, a lot of states try to put together kind of a complicated mixture of taxes in order to be as politically neutral as possible. So for example, in Ohio, we kind of split the difference between a progressive income tax, which does fall as a higher burden on the wealthy, and we also have sales taxes and use taxes that fall the other way, that are regressive. So I think the goal of the government is to try to kind of balance those things out. And of course, we also have a mix of other business taxes and user fees and things like that as well. All right, that is the end of our very, very last video lecture for the course. Pat yourself on the back for all the hard work you've done paying attention to these videos in this online environment. And now that you've watched both videos for the unit, be sure to post in our discussion board. This one's our second to last discussion board for the year. You'll have a discussion board next week, but it's just kind of a wrap-up fun one. You know, I'm really going to miss all of you. I hope that you do well as you study for your midterm next week, and then the final the week after that if you need to take that. The midterm exam study guide's available now, so I recommend getting started with that if you haven't already. And please, please, please contact me anytime by text, phone, or email if you have any questions or anything you want to talk over with me, or you just want to stop by and chat with me in my virtual office hours. So hang in there, guys, and good luck studying.